US economy added just 22,000 jobs in August, so is the labour market in trouble? This is Macro Matters, and we're talking US jobs. August jobs number was expected to be a modest 75,000, but it came in far lower than that. Stock markets are happy because that means a rate cut from the Fed this month is now seen as locked in. But after the news earlier this week that the US has more unemployed people than vacancies for the first time since the pandemic, does this mean the wider economy is slowing? Gregory Daco is chief economist at EY Parthenon. Gregory, what's behind this unexpectedly low number?
Well, I think what we are seeing is a visible cooldown in the labor market. There is broad-based evidence that economic activity is slowing under the pressure of trade policy and immigration policy. And I think this is reflected now in the non-farm payrolls data, which indicate that over the last 3 months, we've only added about 30,000 jobs on a monthly basis. So there is softness in the labor market. It's both a labor demand issue and a labor supply issue. Both are influencing job growth to the downside. And I would also stress that we're also seeing greater job growth concentration in a few sectors, so that most of the sectors are actually seeing job cuts across the board.
How much of this is about the uncertainty around tariffs, do you think?
I think that's very much part of the picture. We are in an environment where businesses are hesitant to invest into the future. They're essentially also facing higher input costs, and the cost of goods and services are rising. And so businesses are having to do that difficult trade-off of how do you manage to protect your margins in an environment where cost pressures are ever rising? And one avenue to do that is essentially to manage talent. So we had seen strategic talent management. Now we're seeing more of a push towards strategic layoffs, less hiring, and that is putting downward pressure on the labor market overall.
You said that labour supply is also slowing. Do you mean that immigration policy is reducing the pool of available workers?
Yeah, I think what we're seeing in terms of the economic data is that the labor force participation rate has been pressured down. That indicates that there are fewer people looking for employment. And that's been one of the factors that's prevented the unemployment rate from rising. If the participation rate had not moved since May, we would have actually seen an unemployment rate closer to 5% instead of the 4.3% that we saw in August. So there is definitely a shock that we're observing from the supply side of the labor market, which is due in part to some of the immigration restrictions that are curtailing labor supply.
Last month's data, of course, was called into question by President Trump, who fired the commissioner of the Bureau of Labor Statistics and is seeking to replace her with a Trump loyalist who hasn't yet been confirmed. Are there any reasons to doubt this data?
Well, I think generally speaking, all statistical agencies have very strong institutional guardrails, and that prevents any type of immediate pressure on the data to go one way or the other. So I continue to very much trust the institution in being able to do the best job possible to deliver the best quality data. And that's why there are subsequent revisions to each report. Once the statistical agencies gather more data, then they essentially fine-tune their first estimates. And that is hopefully going to continue to be the case going forward.
Financial markets now clearly see a certain rate cut this month, since this number makes the case that the US economy needs that help. But is the Fed behind the curve now?
I think the Fed is somewhat behind the curve, yes. I've been arguing for a while now that there was room for the Fed to essentially neutralize monetary policy. Currently, monetary policy is slightly restrictive. And we've been arguing that essentially there are ongoing signs that disinflation is underway on the services side, and that despite the renewed cost pressures from tariffs, these are likely to be a one-time effect on prices and inflation, not a long-lasting shock. I think this morning's data in terms of the labor market indicates that second-round effects are less likely in an environment where labor market conditions are weaker and wage growth is actually easing.
Where can the Fed go from here then? Do you see several cuts this year?
I think we could anticipate a couple of rate cuts from the Fed over the course of 2025. That is one rate cut in September and one rate cut in December. Markets seem to price another rate cut in October, but I would remind everyone that we are still in an environment where Fed policymakers are extremely data dependent. So any type of upward pressure on the inflation front will keep hawkish Fed members on the fence about excessively easing monetary policy. And so you're likely to see split votes over the coming months into 2026 as to the trajectory of Fed policy.
That was Gregory Daco of EY Parthenon. Don't forget, you can watch more videos on Reuters.com.